All right, ladies and gentlemen, welcome to another episode of our Property and Finance podcast. Today we have a special guest, a repeat guest, I should say. We have Nicola Powell, Head of Research at Domain. Nicola, welcome back.
Theo, hi. Thanks for having me again. I can't believe we're at the end of the year already.
Yeah, we did say we'd get you back within 6 to 12 months to reflect some of the things that we spoke about at the time, but time has flown. That was September last year, actually. You were last hosted on our podcast as such, and now we're in the tail end of 2024. So this is also today a bit of a wrap on the year of 2024. There's been a lot of crazy things going on and lots of crazy things I'm sure that you've got some interesting data on. I do have to start off the podcast by reflecting some fantastic advice or forecasts, I should say, that you gave back in September 2023. I did ask you at the time, what was your crystal ball for the year ahead? And you told me that the Domain have a price forecasting model, which essentially, using all the data that you have access to at your fingertips, you forecast growth for the year ahead. And you guys, the house's view as such was that there will be a steady recovery from the year prior. Subtle increases were the words on property prices, and that you see more growth in houses as opposed to units. And the number for Sydney was 6 to 9% increase in houses by the end of financial year. So that was FY24 that just passed us. And we'll see new record highs and growth, which was spot on. You nailed all of them. I think Sydney got 7% in price growth for houses, that is. And most other markets were pretty similar, right?
Yeah, look, and I love being held to account and, were you right? And I think with price forecasting, it is about, sticking your neck out a little bit. And I think, when it comes to buying and selling property, it's most people's biggest financial asset. So it's important that we give as much information as we can, not only our views, but also providing as accurate models as we can. And the great thing that I love about our forecast model is we use behavioural data. And what I mean by that, it utilises the information of what people are doing on Domain. And that helps to inform the future of what we think property prices are going to do. And it's really pleasing to know that Sydney, Melbourne and Canberra in particular, and across the combined capitals, we were pretty much spot on. So, it's great to...
So you mentioned in our little debrief earlier some of the behavioural changes to that keyword data that's going on Domain as a platform, you could say, and there's been some trends. So, last year we were speaking about the fact that houses were the thing that people were confident in growth, but surprisingly there's been a large volume of transactions in units that people probably aren't aware of.
Absolutely, and particularly so in Sydney. So this is a fairly new change that has occurred over the last couple of years. And what we do at the end of the year, we review that calendar year. What were the transactions? What were people looking for? A real year in review. And what we found were, when we looked at the total number of sales that were sold, 45.9% of them were units. And for houses, it was 44.3%. But what we've got is units were the most transacted property type over 2024. That was the same in 2023 for Sydney, but that is a new trend. That is a new trend for the past 2 years. And I think that's very interesting. And it tells me a couple of things. It tells me probably that we have seen investors offload. And I think that we can all acknowledge that some investors have sold their properties due to the fact of the higher for longer cash rate. And I'm sure we'll discuss the cash rate later on. I also think it says a lot about affordability, particularly in a market like Sydney, where we've got to acknowledge that the median house price is grossly unaffordable for your average Australian. We've got that median house price currently sitting at 1.6, and I'm sure we'll discuss the forecast, but here's a little sneak peek. The forecast for Sydney house prices by the end of 2025 is to surpass 1.7 million. Now that, I think, will be eye-watering to your average Sydney-sider.
So isn't that crazy in itself that we are at somewhat record high interest rates, at least for the last sort of 20, or maybe not that long, 10 years or so. And we've got, affordability issues. We've got, alarming data here and there. Whilst some people think that the economy is still strong with low unemployment, we've got record low GDP. the lowest we've seen in decades, in that most recent quarter that came out this month in December, outside the pandemic, that is. We've also got household pressure that you're talking, whilst arrears hasn't crept up, there's undeniably household pressure, which is causing a decrease in spending. Many businesses, we've had record high insolvencies, many businesses are struggling. And despite all that noise, despite interest rates staying high, we're still forecasting some more growth in the property market.
I think when you look at 2024, it just shows the remarkable resilience of our housing market. It also does highlight the undersupply of housing that we do have across Australia that I think continues to drive up property price. And when you think about it, we're in this balance of, well, not balance, is absolutely the wrong word, but we are in this scenario is probably a better word, where we have seen the cash rate higher for longer, but we also have an undersupply of housing. And I think that undersupply of housing is one of those fundamentals that continue to drive up property. And I think, you probably would have seen it yourself. There's been a lot of activity from people who have stake in property already. So they have equity growth. They've seen healthy growth in their own property. It allows them to upsize or downsize and free up equity. But I also think those first-home buyers, particularly that have been active, have been supported by the bank of mum and dad or the grandparents. Particularly in a market like Sydney, it is very challenging. But it's been a remarkable year. It's been a year of economic turbulence, but here we are showcasing the resilience really of Australia's housing market.
Yeah. Well, you've said something a couple of times now, reference to the cash rate, and you also said it's stayed higher for longer. Now, that is definitely the general consensus of 2024. Whilst I gave you credit for nailing the forecast on the property market back in September last year, the one thing that we were both wrong on, that I think most bank economists haven't got right, is the forecast of interest rates. So this time last year, more like even September last year, people were banking on rates to come down early this year. We did see some bad data come out in, I think it was October, from the previous month inflation, which then triggered that rate rise in November. But then we went into the start of 2024 thinking rates are going to come down and confidence was strong. But we still haven't got that rate decrease this year, which was just the goalpost just kept moving on everybody. Everybody was working toward that rate relief that never came. And it feels that that same thing's still happening, right? Where inflation is back down to that 2.1%, headline inflation that is, but people are worried about this trim mean inflation, or when I say people, the RBA in particular. The goalposts, people were thinking, okay, February we'll see a rate cut. Now that's looking a bit vague, and it's looking like maybe after the election, maybe more like June, July. How's that, correlating and transferring to what you're seeing in activity online with these constantly changing forecasts every few weeks? Some new economist coming out with a new view.
Yeah.
Surely that affects online activity to what you guys are seeing at Domain and confidence in trying to buy a property.
I think it absolutely has a huge influence in people's decisions. I've got a really beautiful graph, and hopefully I'll share it with you afterwards. Hopefully you can share it on this podcast, that maps exactly what you just described. It's the cash rate and then what they call the market implied yield curve, which is the market pricing of where the cash rate is going to go. And I snapshot this at points in time, and I did it at the end of 23, early 24, mid 24, and very recently. And it showcases everything that you just described, where rates were going to go down, then they were going to go up, then they were going to go down, then they were going to go up.
It's like a yo-yo.
Yeah, absolutely. And that is very confusing. I think that what that creates is a real mixed message. I think it showcases the complexities of our economy, not only domestically, but globally also. But I think when you come to Australians who are trying to decide, is now a good time to buy? Should I wait for rate cuts? There will be some buyers that entered 2024 thinking, I'm going to get a rate cut soon. Let's buy now before all of that transactional activity comes to market, because we know when rates are reduced, that does bring people to market. So I think it's been a very confusing year. And as we get to the end of the year and then we look back, this is the most stable period that we've seen in the cash rate since it was at that rock bottom during COVID at that 0.1. So, it's felt like a roller coaster for the cash rate, but actually it hasn't, because the cash rate hasn't moved. And I think that what we've got now when we come to the end of the year, absolutely it is influencing people's decisions, particularly to buy property. When we look at the shift in change of conditions, towards the end of the year, what we've got now is a build-up of stock. And I think buyers are waiting. They're waiting because they want confirmation that the RBA are going to start loosening rates. That is not going to be, we know it's not going to be this year. We've just had the latest RBA, it's unchanged. I'm going to put my neck out and I'm going to give my prediction of when they will be reduced in 2025. It is going to come in 2025. I'll be really shocked if it's not. And then I'm going to throw to you and ask you the same question of when you think it's going to be reduced. So obviously there is a longer period now between when the RBA are meeting. And I'm going to pick April Fool's Day. April Fool's Day will be the day that some banks are saying May. Look, it might be May. I'm in a camp between April or May, but I want to go with April Fool's Day. I do think that we will see rates being reduced. You said the GDP figure is literally like a tumbleweed. It is barely doing anything. And what you tend to find is when you've really got that slow economy, it will translate into a higher unemployment rate eventually, but that unemployment rate does lag. So I do think that the RBA will be moving and I'm going to pick April Fool's Day. When's your pick?
I don't think April, only because it's just going to be before the federal election. And
yep.
I think sometimes they avoid big decisions like that. So the acting government can't take credit for it, which is just nonsense if you think about it. But I think it'll be post the election, just so no one's taking credibility for it. But let's just go back to a few things you said there, because you said some great stuff. So firstly, confusing year. That is the best way to describe 2024, a forecast, let's call it, of interest rates. One bank saying left, the other one saying go right. It's just been non-stop mixed messages about when rates will come down, whether they're going up or down. It was still left for speculation. Something else you spoke about, the things that we typically see in the property market, and especially, let's say, in our business in mortgage lending. We've been doing this. I've been personally doing home loan lending for around 15 years, and always that last quarter of the calendar year is typically the spring selling. It's the busiest sort of period of selling and buying houses. However, this year and last year, that hasn't been the case. Now, there has been obviously external reasons why. Last year, we had that Gaza war sort of breakout, followed by that rate rise in November and the forecast that we might have 2-3 more rate rises to go, and that changed by January, and then things were strong again. But then this year, same thing happened. The forecast of when rates were going to come down got pushed back with some later sort of inflation data that came out. And once again, to your point, and that's something we should probably highlight, this supply level of housing, these stale listings, so not supply in terms of stock and the amount of new homes being built, but the supply of stale listings left on the market which aren't being sold, mainly because vendors' expectations are still up here and buyers' expectations, it's now clearly a buyer's market and they're looking for discounts. They're thinking that there's good deals to be made. And, just because you thought your property is worth X back in COVID or 2022, it doesn't mean it's worth that today. So there's this bit of a glut in the market right now that you're seeing, right?
Yeah, we have got a build-up in supply, and it's really interesting when you look across the different capital cities as well. And I think what we've got to also highlight here is we're talking about overall choice on the market. This still doesn't address Australia's undersupply of housing and the housing crisis that we have.
Yeah, two different subjects.
Yeah, we still have very high house prices, and the house prices are so high is because we don't have enough of them. But there is a clear distinction as well between the different capital cities. There are some capital cities that are still very competitive, and that is Perth, Adelaide and Brisbane. These three capital cities are well below their 5-year average. So, for example, rural supply in Perth is 26% below the 5-year average. 24% below the 5-year average in Brisbane. If we then focus on some of our other bigger capital cities, Sydney and Melbourne and Canberra have supply higher than the 5-year average. And that's exactly what you just spoke about, that pendulum swinging in towards buyers, that mismatch between seller expectation on pricing and what buyers are willing to commit to. When you look at Sydney, total supply is 19% higher than this time last year. Vastly different spring buying conditions for buyers out there. 13% higher than the 5-year average. Melbourne's very similar, and Canberra, I'm actually based in Canberra. I keep looking around and go, what have I said to my neighbours? They're all moving. Like I've clearly done something.
It's because you got the interest rate forecast wrong.
Yeah. Overall supply in Canberra is 38% higher than the 5-year average, 28% higher than this time last year. Massive difference. So you've got Sydney, Melbourne, and Canberra, where supply is improving, rebalancing in Sydney, shifting towards a buyer's market, where in Brisbane, Adelaide, and Perth, it's still quite competitive.
So let's talk about that. So just to call out that point, those cities are basically still seeing low stock levels, is what you mean by below the 5-year average of supply. So when properties are listed, they're being sold generally, right, for clearly acceptable prices. What do you reckon some of the reasons causing that is? Because I've got my own theories and assumptions, you could say. Some I see happening quite commonly in Brisbane is just the interstate migration for affordability, right? It started to happen a bit for us in Sydney with people going to Perth as well, but I think there's been a huge amount of people from Melbourne and Sydney just realise they can't afford what they want locally, and now thanks to new working from home arrangements, they're packing up their bags and they're going to Brisbane or Perth, right?
Absolutely, they are. The affordability aspect is there. And I think as well, it's not only people moving, it's what we call rent vestors. So a rent vestor is someone in Sydney. I'm using Sydney as an example because it's so high priced.
Expensive, yeah.
Yeah, people are still renting in Sydney, but they're going, I want a stake in the property market, and they're becoming a rent vestor, and they're investing and buying a property in Perth. So the housing crisis in Sydney, in a way, is also impacting Perth because they're going, well, let's buy elsewhere where we can afford to purchase. But I agree, population dynamics, strong levels of interstate migration, and particularly for WA, where normally in the years prior it was in negative. So what that means is more people were leaving WA and then arriving. That is the flip reverse now. There's strong flows of people going in. There's also an element that I think they're coming off a low base. And when you look at a market like Brisbane and Perth, they underperformed in the 2010s. I remember constantly talking even about Brisbane's oversupply of units. That is absolutely not the case today. I think that they've come off a low base, they've underperformed, and there's this mean reversion that we talk about in economics where you tend to find that property movements in price go back to that mean. And I think it's pretty much what we're seeing coming out of Perth. The affordability aspect is still very strong. And I think that, that's playing out in the supply and demand. And also these cities are some of the tightest rental markets in Australia. They've got well below 1% vacancy rates. And that has flow-on effects. There's lots of interplay between for sale and for rent. If you are a renter, you cannot find somewhere to rent to get a roof over your head. You will fast track your purchase into the property market. Even if it means getting a 1-bedroom unit, you just try to get in and buy what you can afford. So I think there's various dynamics.
Yeah. I think just to call out one thing there, because we actually did a piece in The Guardian, I think it was, on exactly that rent vesting strategy that we're seeing quite often in our business. So we're seeing, and you're spot on with the reasoning behind it. Someone might have accrued some savings and they want to buy a property, but they can't afford to buy a property in Sydney, but they may as well enter the property market and start climbing that property ladder. But the best way to do so is just by buying an investment property in another market like Queensland or WA. And there's an argument to say that it might be a better investment for them because the typical investments they're looking at have a much higher yield than the local investment. Absolutely. So there's definitely a lot of that going on.
Not only higher yielding, but when you look at the forecast of growth, we are still predicting with our price forecasting that Perth and Brisbane and Adelaide are going to be the strongest markets in 2025 in terms of price growth, particularly so Perth. Slower rates of price growth than what they saw over 2024. So we probably see, say, Perth increase by about 20% this year. Next year, we're predicting it to be between 8 and 10%. So slower rates of growth, but still the strongest. So I think it's the growth. Yeah, gross.
I would not have expected that because Brisbane I get. So I think Brisbane is technically the highest growing city by population growth in Australia at the moment. Is that right? Has been for a while?
Yeah, one of them, yeah. I think...
And I get why there because at least it's still on the East Coast. So, if you're working between cities and, you've got to travel or communicate at least online, it's fine. But when you go West Coast, you've got time differences to take into consideration if you are still working with East Coast businesses. And whilst affordability might be addressed, you could say, with housing, There's an argument that the general living expenses in Perth can be higher because it's so remote. I think it's technically the most remote city in the world, with the second biggest desert on one side and then the Indian Ocean on the other. So it's quite hard to get sort of goods there, and it means that a typical good is quite expensive, right?
Yeah, but I think the fundamentals are still there for Perth. There's still a bit more wind in the sails for this growth cycle. Definitely easing in terms of the rate of growth. So it's rising, but not rising as fast. It still has an extraordinarily tight rental market, and it still has strong levels of interstate migration supporting growth into WA. One of the interesting aspects, though, that we did pick up for Adelaide and Perth is an increase of inquiries originating from the city but going into their regional markets. The affordability dynamics, as you mentioned, are changing locally for those capital cities. And we already know this for Sydney. So we know that a lot of people from Sydney look into regional New South Wales and they relocate. But some of those dynamics are accelerating for cities like Perth and Adelaide that have seen extreme rates of price growth. Look, I love a number. I'm going to throw these numbers at you. When you look at the change in house prices from now compared to 2020, Adelaide house prices have gone up 79%, Perth has gone up 69%, Brisbane has gone up 67%. How much do you think Melbourne's gone up by in that period of time as a comparison?
So what was that period?
March 2020 to now.
March 2020 to now, I'm going to say Melbourne's only gone up 10%.
Almost bang on the money, 12.5%.
Oh, there you go.
During that period. Sydney's sitting at about 43%, but what that showcases, my point being, there's huge amounts of diversity across our capital cities, huge amounts of still momentum in some of them and less momentum in others. But a 12.5% makes Melbourne the weakest performing capital city since March 2020, which is very surprising because Melbourne and Sydney tend to follow one another very, very closely, and they have not done that this price cycle. There's
been some external reasons, once again, for that as well, with the state government sort of not making it attractive for investors and landlords. And there's, the supply of houses there, so supply of units has really dried up, right? Which you'd think should put upward pressure on prices, but they've been still building the house and land sort of packages and subdivisions on the outskirts. The only reason I know that 10%, well, it was 12, but the only reason I could come close to guessing was because of the amount of frustrated clients we have in the Melbourne city who, you know, Australians live and breathe property, and we look at property as an asset class to invest in. And when you put all your eggs in one basket and bought a property and then you haven't seen growth in 3 years whilst all these other neighbouring cities around you have gone crazy, it's quite a frustrating position to be in.
Absolutely. I mean, I don't think I've ever seen, we've got about 30 years of price history, pricing data. I've never seen Melbourne see such stagnant conditions. It's pretty much flatlined since June 22. It's pretty much done nothing, a few wobbles here and there. Really unusual. I think for buyers, though, it does create really good negotiation power and good value. And I think what we're seeing in Melbourne is value is building up over time. And I really believe that when we move into the next price cycle, so I'm not saying 2025, but I'm talking maybe 26, maybe 2027, what we're likely to see is Melbourne will overperform relative to our other capital cities because it is providing so much value. And I think it's really interesting. We were talking about keywords, might have been off air earlier. And in Melbourne, we've seen a big shift in keywords. And the keywords that have risen through the ranks are Art Deco and heritage. Now, we know that Melbourne has beautiful homes for Art Deco and heritage, but what I'm interested in is that change. We've seen a rise in buyers searching for that type of home. What that tells me is buyers are utilising stagnant market conditions to purchase their dream home because we know those types of properties, they come at a premium. So this is an established buyer, they're an affluent buyer often, they come at that higher price. And when you look at, when you're staring down 2 years of Melbourne doing nothing, what that says is there is value in this market. This is the opportune time to secure my dream home.
Well, it's funny, some other podcasts that I actually listen to talk about how Melbourne's gone through this sort of painful period, and at what point do people start thinking now's actually a good time to buy, and you're basically calling out that that's somewhat already happening. And what's probably happening there as well, to what you're saying, is that there's a shift of what people see as a valuable asset. If you're going to put, once again, all your eggs in one basket to accrue wealth in a property, I think, despite the comment about the increase in units that we said earlier, in Melbourne, the problem with units is for a decade they've barely moved in value because of the supply of new units constantly to the market. Let's say a one-bedroom unit was $400,000, and then a new developer comes along and sells a new development with another one-bedroom unit at the same price. Well, then your property's not going to grow in value if the brand new one's the same price, right? So I think what's happened is that a lot of these unit owners are now going, I want to buy the rare blue chip commodity, let's call it, being this Art Deco home, right?
Yeah, absolutely. And I think, those Art Deco homes tend to be in these premium locations. And the thing with the premium locations, those suburbs, they are a bit more volatile in price. And what that means is they tend to see greater rates of growth during an upswing, but they also see greater declines when prices do move into a downturn. And I think when you look at a market when it moves into a recovery happens at grassroots level. So a recovery happens driven by owner-occupiers that kind of really know their localized market dynamics, and they go, right now is the time for us to make that move. And I find it fascinating to watch that unravel, and then you get that momentum, you get investors coming in, and it kind of changes and creates that FOMO. And they're the various stages of a property price cycle, particularly when you're moving into an upswing.
The FOMO is real.
Absolutely it is.
Yeah.
I think if anybody has attended an auction, you can see that FOMO, particularly when it's a really running hot market. And, we don't have FOMO at the moment. I think buyers out there are realising that they can take their time. And even in those markets that we're just talking about that have really strong conditions, we're now starting to see even a slight lengthening of days on market in those. They're still very, very short, I will add, in terms of the days on market, but we've got a slight lengthening of days on market. And I think, I'm keen for your view on this, but my personal view is property is a long-term investment. And there's an element that we should, while property price cycles are important and we should have a deep understanding of what's going on, if we focus on that long game, those price cycles and the bobs that, the dips and the peaks that happen along the way become less important. And I think sometimes we forget about that long game that property should be.
That's amazing advice. I couldn't agree with you more. I wish you were head of our marketing and newsletter content here at Shaw Financial. I understand why you're such a valuable asset to Domain, because that is so well said and such a perfect sort of belief we should make people realise that we see people trying to reflect every year of growth on their property and annualise it, and trying to bump up their valuation every year or two and get access their equity to go again. And while sure that might be a successful activity, I think that just let go of analysing every year that was in growth and just realise that you're buying that property for a long-term play. The other thing that I don't like that we see is people buying properties for 2-3 years. It just doesn't make sense to do that with stamp duty and other costs like agent fees. If you think stamp duty and selling costs call it 6.5% of your price value, and you've moved 10-15% in growth, there's pretty much half your growth in selling costs and stamp duty. So it is a long-term game. Completely agree with you there, Nicola. That's a great shout. Did we cover everything in this Domain end-of-year wrap for 2024? And have we got any more crystal ball forecasts for 2024 now with this new adjusted price forecasting model that is going to take the yo-yo consideration of the interest rates and all that?
Yeah, and looking in our forecast model, we place more importance on the consumer behaviour than the cash rate. I will answer that question about the forecasting, but I'm going to transverse into another piece of analysis that we did that I think you'll find really interesting. So we looked at the impact of 1 percentage point increase in the cash rate, and also what the equivalent was for population growth. So we were basically trying to answer the question of growing population, how does that affect property prices? Increasing cash rate, how does that affect property prices? And what we found was an increase in cash rate has a negative impact normally on property prices. So what that means is when rates are reduced, that will have a positive influence in terms of pushing prices up, because it logically increases borrowing capacity, it brings people to market. But the key thing that we found was population growth. We've seen population growth significantly high over the last couple of years. At its peak, it was like net overseas migration was running at 600,000 in a 12-month period. What we found was population growth has a long-term collective impact on house prices. So it has a positive influence and it's over that longer term, which makes sense because if you arrive in Australia, you tend to rent. And then the longer you stay in Australia, the more likely you are to purchase. And then you think about the life stages of buying and selling property. As your family grows, you maybe go from a couple to having a couple of children. That impact is much longer term on our housing markets. And I think we are still feeling those impacts of strong rates of population growth over the last couple of years. That is still being felt today in our housing markets. And so our forecasts for next year are for properties prices to continue to rise. And when I look at the numbers, we're forecasting prices are going to rise across all of our capitals. But the headline is it's a slower rate. So they're rising, but not as fast as this year. What we're expecting is, and you'll hold me to account, I hope, at the end of next year, what we're predicting is a 5 to 7% increase in house prices across our capitals. For Sydney, that's a 4 to 6% increase. And for unit prices, a 3 to 5% increase across the capitals. And in Sydney, actually a 4 to 6%. So for Sydney, the headline is 4 to 6% for houses and units. That's a strong call because what we're predicting is units are going to see as equal growth as houses. And that hasn't been the case over the last couple of years. And that call is coming from affordability impacts, first home buyer initiatives such as Help to Buy. It's all going to steer demand towards that lower end. And I think that we will see units see as much growth as we see for houses.
I think the key word with multiple things you're referring to there is affordability, right? So what's going to drive some price growth next year is affordability improvements by rates coming down. And what you're just referring to with units probably catching up to houses is once again affordability, because that disparity between the two grew a bit in recent years. Units didn't really perform as well as houses through that COVID boom, but now people are chasing value. And if you've started a family in recent years and you need some space, there's some better value buying in a 3-bedroom unit than a 3-bedroom house. That's for sure. You'll get probably the same, if not more, internal living area.
Yeah. And I think that's important. It's important for buyers. I think 2025, though, is going to be an interesting one because I do think it's almost going to be like a year sliced in half, because I think we do have slower conditions currently in our housing market, and that is going to roll over into 2025. So what I'm expecting is, we have a spring selling season, which is normally the peak in activity. Then you have the autumn selling season, which is the second, highest level of activity that we see. We're likely to see better buying conditions rolling into autumn next year. And I think that if you're a seller, you have to price your home right to get a speedy sale. But I think once we start to see rates being cut, and it's not going to happen from the first one, but I think what we're likely to see is once rates being cut, what that will help to do is boost sentiment, so boost confidence in Australians. And when you start to see rates being reduced a few times and you've got rising consumer sentiment, so that confidence, that tends to play out positively for our housing market. So what my pick is, the first half of 25 is going to be weaker, and then the second half we'll see a better outcome than what we did in the first half. So I think if we're going to see growth, it will be likely I wouldn't be surprised if we see prices decline over the first quarter, maybe the second quarter, and then what we'll see is a better outlook for the second half.
Where we should definitely hopefully witnessed some rate decreases by then. And it's true, I think also autumn might be tough because historically leading up to an election there's more uncertainty, so people are less confident about making a decision. Something that you also touched on, and it's so true, and once again it goes to the recent experience we saw in 2024. People making decisions and becoming confident, and sentiment is affected by just a forecast, not an outcome, right? This year, the changing forecast, and when rates were confidently forecasted to decrease, people would act on that forecast and run out there and buy a property. And then as soon as the forecast changed, people stopped looking. And it's crazy how a forecast can influence a decision. The rates this whole year have stayed the same, but we've had periods of stronger and weaker confidence and sentiment as such?
It's one of the aspects I love about analysing Australia's housing market is the influence that behaviours have. There is this massive behavioural impact that sways people's decisions. And I think that it's important that everybody has as much information as they can to be able to make better decisions and better decisions based on the data that is available. So, I'm a strong advocate of making information available, putting out forecasts as robust as we can. Forecasting is very, very hard in terms of forecasting where prices are going to go. But it does, I think, influence people's decision. And we have on this thread of the cash rate higher for longer and that we all got it wrong, we have a unique data set at Domain and it's called distress listings. So we track properties that are must sell, urgent sale, price reduced, mortgage repossessed. And we track that as a percentage of overall listings to tell us, it's like a health metric, to tell us how is our housing market responding to that environment of higher for longer? Because ultimately, the longer the cash rate stays higher, the more vulnerable our households are to mortgage stress. And I think particularly in a high price market like Sydney. And what's interesting at that macro level, across our cities, the proportion of distressed listings have slowly been declining. And I think that's partly because we've had record pricing, we've had fairly good conditions for selling this year, particularly in that first half. So if somebody is in the position where they are having to offload their property, the full recovery in prices and record pricing helps to reduce the financial impact. But what I would say is there are pockets of weakness. And I think that we have to acknowledge that there are some areas in Sydney that are really under strain from repaying their mortgages. So just over 1 in 10 listings in some of those pockets of the mortgage belt of Sydney. So this is areas like Parramatta, it's areas like Backtown. 1 in 10 just over are distressed listings. And that is high. That's really high relative to...
Well, it's 10%.
Yeah. I think it's sitting at about 11% from memory. So it's just over. But when you look at a macro level, some of our cities are sitting at, I think Melbourne was at 3%. Which is very, very low. But when you've got other areas that are high, it's risky.
It's funny, you would actually have access to this data probably more promptly than consumers and some banks do, right? Because banks are on a different story with arrears, but we don't really find out about an increase in arrears rate until sort of 3 to 6 months after the fact, because they don't get reported for 90 days. They've got to be, 90 days in arrears before it's reported, where you're finding out at the forefront if it's becoming a stale listing, and that could be someone that is trying to sell the property because they're in a distressed situation. That's really interesting data that you have. So where, just going back, and I'm going to put you on the spot here, forgive me, Nicola, but where is there a concentration of certain areas where you're seeing more sale listings? You mentioned Parramatta. Is it more sort of, in our State of Sydney report, we call it sort of heartland Sydney, the more affordable areas of Sydney, which is probably the outskirts? Is that where there's a bit more distressed listings? Because there's also been a huge amount of supply in those areas with new houses being built. Is that what's going on?
Yeah, so it's pretty much those areas. So as you were talking, I was, hot off the press looking through those the data. Parramatta, 11.3%, Blacktown, Marylands, Fairfield, Mount Druitt, they're all sitting at about kind of 8 to 9%. Some of these areas have seen a minor decline year on year, but somewhere like Mount Druitt, that's actually increased. It was at 5% this time last year, and it's now sitting at 8.3%. So I'm always interested or alerted to those areas that are higher than the kind of baseline for the location or the baseline for the city, and those areas that are seeing an increase. So I know that, for example, I've been tracking Blacktown as one of those hot spots for a while, and it was constantly seeing year-on-year increases. It's very interesting, though, it has declined, so that is a positive sign. But absolutely, it's all of those, those affordable areas as you described. It's that mortgage belt. So it's the people that are vulnerable, and you would know this deeply being in the industry that you are. It's those people who are early on their purchasing journey. They don't have equity. They're highly leveraged. They're vulnerable to higher for longer. They're the ones that I think are really vulnerable. And what's interesting in this, it's not necessarily those people who have gone into mortgage arrears or mortgage repossessed. It's those homeowners, and I've spoken to many people where they've wanted to sell quickly before they get into that situation.
Yeah.
And they can foresee it coming, where they're just not going to be able to meet their mortgage repayments in 3 or 4 months. So they're selling now to get out of it as quickly as they can.
Yeah, we're seeing a lot of that. People do act before the fact, which is good. I feel like the modern day consumer is quite acute to their finances. And even when we had those infamous mortgage cliffs that people were facing, and with, their fixed rates going from 2 to 6%, people were forecasting that hurdle ahead and making adjustments like downsizing. I think another important call out in those areas, and correct me if I'm wrong, I think there's been huge amounts of units in Parramatta, same as Blacktown, lots of supply. And you're right, we do a lot of financing in those areas. Huge amounts of first home buyers and investors. And now I'd say those investors are also predominantly, to your point earlier, rent investors. So that it's technically their first property, but they're just renting it out, and they look like good areas of opportunity to buy and invest in, because as a rental yield, they were also better than other local areas in Sydney, you could say. Maryland's, funny enough, there's been some developments going on there, I believe, but not a huge amount of supply. But yeah, we are seeing in general in the last year, what we saw in our business was that people sort of shifted away from those areas of units and were chasing rather more like a house and land package. So it's interesting to your point earlier that actually across the board there's been more of an increase in units rather than houses. Something I also wanted to ask you before when you stated that stat, which I think it was like 45.9% units, and then 44 was houses, thereabouts. People are going to be questioning, what's the miscellaneous? What's the...
Oh, yeah. So it's all the missing middle is how I describe it. So townhouses, and this is all stats for Sydney, townhouses were 6.6%, semi-detached 1.2%, and a duplex 0.8%. So it's all that missing middle. And I look at this and I think Sydney has a massive amount of missing middle of affordability. So we've got, close to a record price gap between a unit and a house. A house in Sydney is twice the price of a unit on that medium price scale. And what townhouses do, I'm a real strong believer in we need to use the land that we have efficiently and effectively, particularly in a city like Sydney that cannot just continuously sprawl like Melbourne. It's geographically contained by ocean and blue mountains. So when you've only got 6.6% of townhouses being transacted, what that says to me is we should probably try and boost that with supply and that missing middle. Adding those stepping stones onto the property ladder, it will help improve affordability. And I'm going to give you a comparison. So 6.6% is very, very low. When you look at Perth, where we know Perth is much more affordable, townhouses accounted for nearly 20% of sales versus Sydney at 6.6%. Vastly different stats.
Is that just because obviously it's more feasible to build townhouses in those markets, right? Here, I think locally, the land is too valuable where you can do sort of medium density housing. You may as well go up a few levels and put units, right?
Yeah, and the comparison between the unit stock in Sydney and Melbourne is very, 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 very stark. The difference is very stark. But I do think it does offer an opportunity. We did, I have to share this with you, we did a new development report which looked at what buyers were looking for, and it was a Sydney-specific report. So perhaps you could share it with your audience. I think it would be great interest because we only released...
Please.
And it was looking at mismatches between what people were searching for and what was being supplied. And we looked at price point, location, some of the features that they wanted within the home. And what we found was for people who were searching for a townhouse, there was no geographical bias. So with a house and a unit, there is geographical bias. So unit searches are concentrated within this, the close to the city, and houses increases as you get away from the city. But with townhouses, there was no geographical bias. And what that tells me is people are open to options. They're driven by a price point and affordability, but they're open to options. When they start a search for a property, they often what we call are on multiple journeys, and they're considering multiple different property types, something that fits within their location and fits within their budget. And I think townhouses often are considered irrespective of location.
That's a good shout, 100%. All right. Well, I think we've once again, just like last time, we've probably kept you longer than expected. This is one of our longer podcasts, just because you've always got such insightful tips and tricks, you could say, and you speak with passion, which is lovely. If we're going to conclude and summarise the crystal ball, the call-outs I heard that we'll hold you to at this time next year was, I think it was Adelaide, Perth and Brisbane are going to be the top picked cities for growth for the year ahead. I think we said April for the RBA cash rate cut, which I somewhat agree. It's either there or May. I'll stay impartial.
I think you're being optimistic, quite clearly.
Yeah. And I think that was in a nutshell. And I think in general, even in the markets like Sydney and Melbourne, which have had record prices and still, expensive properties and affordability constraints, there's still some expectations of growth purely from affordability improvements with rate decreases. Was the conclusion there? Was that right?
So I think for Melbourne, we're expecting minor rates of growth, 3 to 5% for houses, but we are anticipating a little bit of a price fall for units, but not much, pretty much a flat line of growth, anywhere between 0% to -2. I think Melbourne is still going to see that weaker conditions unravel over 2025 like it has over the last couple of years. There needs to be some real shifts in market dynamics to see momentum build back into Melbourne. But I think my pick for Melbourne is longer term, throwing into 26 and 27. That's probably when we'll see greater rates of growth for Melbourne. It's undervalued. That value has been building up over time, and there will be a point in time that buyers and owner-occupiers realise that.
Well, thanks again for your time, Nicola. You've been great as always, and let's reflect those call-outs next year, and hope you have a lovely break over the Christmas period. And thanks again for joining us.
Thanks for having us on again, Theo, and I look forward to being held to account next year.
Well, you did say you like to be held accountable, so we'll do so for you. All right, thanks again.